FOMO, fear of missing out, is a powerful force that can drive investors to make impulsive emotional decisions. In investment bubbles, FOMO amplifies as people rush to buy assets simply because others are making profits, pushing prices far beyond their true value. This herd mentality often fuels unsustainable growth, eventually leading to sharp crashes. Understanding the role of FOMO is key to recognizing when excitement turns into dangerous speculation. Today we will talk about the role of FOMO in investment bubbles. So before we start, make sure to hit the like button and subscribe to my channel. 1. The power of FOMO in markets. Fear of missing out, or FOMO, is a powerful psychological driver that often shapes investor behavior. It stems from the basic human instinct to avoid regret and not be left behind when others are seemingly gaining. In financial markets, this fear can quickly override rational decision-making, causing investors to chase rapidly rising assets without adequate research. FOMO fuels herd mentality, where individuals copy others' investment decisions, believing they must know something they don't. As social media, financial news, and peer discussions amplify success stories, more investors pile in, escalating demand and pushing asset prices beyond reasonable valuations. The psychological pressure can be overwhelming, especially when people see peers or influencers profiting seemingly overnight. FOMO is not just limited to novice investors. Even professionals can fall prey when the opportunity seems too good to miss. It can distort risk assessment, encouraging people to invest beyond their means or buy into assets they barely understand. Understanding the psychology of FOMO is essential to identifying when markets are overheating and to making more disciplined, rational decisions that aren't driven by emotion. FOMO is often the spark that ignites and accelerates investment bubbles, which can eventually lead to catastrophic corrections once reality sets in. 2. FOMO and bubble formation. Investment bubbles typically form when the price of an asset is driven far beyond its intrinsic value, and FOMO is often a key accelerator in this process. Initially, bubbles begin with a sound economic idea, new technology, scarce resources, or disruptive innovations. However, as prices start to rise, FOMO attracts more investors, not because of the underlying fundamentals, but because they fear missing the next big opportunity. This fear feeds on itself. As more people buy in, prices rise further, creating a feedback loop. Media coverage, influencer hype, and success stories of early adopters add fuel to the fire. Traditional valuation metrics are often ignored as euphoria takes over. Investors begin to rationalize that this time it's different, believing the price can only go higher. FOMO blinds participants to warning signs such as unsustainable growth, lack of real profits, or overleveraging. As more capital floods in, the bubble inflates quickly, sometimes within weeks or months. 3. Social media's amplification effect. In the modern investment landscape, social media plays a pivotal role in amplifying FOMO and accelerating bubble formation. Platforms like Twitter, Reddit, TikTok, and YouTube have transformed how quickly information, and often misinformation, spreads. Viral posts, meme stocks, and trending hashtags can spark massive inflows of retail investors into specific assets almost overnight. The echo chamber effect on these platforms intensifies FOMO, as users are bombarded with success stories, screenshots of gains, and bold predictions of untold riches. Emotional narratives often override critical analysis, and investors can quickly feel isolated if they aren't participating in the next big thing. 4. Historical bubbles and FOMO. Throughout history, investment bubbles have been driven by the same underlying FOMO dynamics, even though the assets and times change. The tulip mania of the 1630s is one of the earliest recorded bubbles, where the prices of rare tulip bulbs skyrocketed due to rampant speculation and social pressure to own these prized flowers. In the 1990s, the dot-com bubble showcased how FOMO can engulf entire industries, as investors poured money into internet companies with little more than a website and a promise of future profits. The housing bubble of the early 2000s similarly demonstrated how fear of missing out on skyrocketing home prices led millions to overleverage themselves. More recently, the cryptocurrency boom and the GameStop stock frenzy in 2021 illustrate FOMO's continued grip on investor psychology. 5. Retail investors and FOMO traps. Retail investors are particularly susceptible to FOMO, often lacking the risk management strategies and discipline frameworks that institutional investors typically employ. With easy access to trading apps and instant market information, the barriers to entry are lower than ever, increasing participation in speculative trends. Social media feeds, online forums, and even friends' success stories can create immense pressure to join a rally in progress. Many retail investors jump in at the peak, buying high and selling low when panic sets in. FOMO can also lead them to abandon diversification, over-concentrating in a single hot stock or asset class. Unlike professional traders, most retail investors don't have access to sophisticated research tools or hedging mechanisms, making them more vulnerable when the bubble bursts. 6. FOMO's emotional cycle. FOMO-driven bubbles typically follow a predictable emotional cycle that can trap investors at various stages. It usually begins with optimism, as early adopters start to see gains. Excitement builds when media coverage and social sharing amplify the asset's rise, drawing in more participants. As prices surge, euphoria takes hold, where risk is dismissed and unrealistic expectations dominate. This is the critical point where FOMO peaks. Investors rush in, not because they have done analysis, but because everyone else is profiting. The emotional high is often followed by anxiety as prices begin to fluctuate. Doubt creeps in, but many hold on, hoping the rally will resume. When the inevitable correction happens, panic sets in, triggering mass sell-offs. 7. Combating FOMO in investing. Overcoming FOMO requires intentional strategies and disciplined thinking. First, establishing a clear investment plan with defined goals, risk tolerance, and time horizons can serve as a safeguard against emotional decision-making. Sticking to preset rules, such as not allocating more than a certain percentage to speculative assets, helps maintain balance. It's also essential to practice patience and accept that you can't catch every rally, and that's okay. Regularly reviewing fundamentals instead of chasing price movements can keep you grounded. Another effective method is setting automatic investment contributions, which shifts your focus from timing the market to consistently building wealth over time. Limiting exposure to hype-driven content on social media can also reduce FOMO's emotional triggers. Many seasoned investors intentionally avoid checking prices frequently to minimize impulsive reactions. 8. FOMO's lasting impact. Even after a bubble bursts, FOMO can have lasting psychological effects on investors. Many who experience severe losses develop a heightened sense of caution, sometimes leading to risk aversion or sitting on the sidelines during legitimate opportunities. Others may swing the opposite way, trying to make back losses quickly by jumping into the next speculative trend, creating a cycle of repeated mistakes. FOMO can also distort an investor's perception of what is a reasonable return, as the outsized gains seen during bubbles become an unrealistic benchmark. The emotional scars from these experiences can linger for years, influencing decision-making far beyond the original bubble. Additionally, FOMO-driven bubbles can shake overall market confidence, sometimes resulting in tighter regulations, increased scrutiny, and shifts in investor behavior across entire sectors. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.